All right, now let's talk about financial leverage. So, like the fixed costs associated with, a big um, um, capital-intensive project that is going to hit you if demand is low, then you can think of a fixed cost associated with financial debt that is going to result in some sort of risk from the perspective of shareholders. So if you want to think about it, when you issue debt as a corporation, you're basically obligated to meet certain payments on an annual basis, right? Now, what is the downside for the stockholders is if the profits of the corporation is low, right? Most of the cash flows are going to go to the debt holders, and nothing is going to remain to stockholders. Had the whole company been financed by equity, then equity holders would have a better chance at obtaining some sort of cash flow even when the profits are low. All right, so that's basically the idea behind the risk associated with financial leverage. Okay. Um, we've already seen some sort of leverage before, right? So if you remember the okay, like uh, something wrong with, well, never mind. You already know that. So if you remember the um, capital market line, we had this market portfolio that was a tangency between the line and the efficient frontier. Now the segment above the tangency would be where the investor would borrow money, and the point that the segment below that point was where investor would be investing in both risk-free asset and market portfolio. So the upper segment would basically represent some sort of a leverage investment outcome. Okay, now just to get at what I was just explaining with regards to stockholders' risk, think about this example here. So we have an all equity finance um, corporation. Now the club, um, uh, the expected future cash flows in this corporation is $300, and that's per year. There's also a minimum of um, $100 of cash flow to this. So this actually we'll see is going to be quite important later on. The shareholders currently require 15% rate of return. So that's the required rate of return by shareholders. So let's denote that by RE. Okay. We're going to analyze the impact of shareholders' return on shareholder returns if the corporation issues 1,000 units of risk-free debt, $1,000 of units of risk-free debts with an interest rate of 10%, so basically bonds with 10% coupon rates, and then uses the $1,000 to um, buy back the dividends shares or pay dividends to shareholders, whatever you want to think of it. Okay, and we're going to assume perfect markets, right? And then recall that in perfect markets, the split between debt and equity is not going to matter for the cost of capital. All right, so let's think about this. So currently we have a value of Clausen and Swift Corporation that is like a perpetuity, which is going to deliver $300 per year, and then a required return is 15%. So $2,000 is the current value. Okay. Now, if $1,000 debt is issued with a cost of 10%, what that means is that there's going to be an obligation of $100 per year for interest payments. Okay, and because the minimum annual cash flow, right, is actually $100, this means that there is no default risk. So that's what I meant when I said, that minimum is going to be quite important later. Now, issuing debt of $1,000 and paying the proceeds to the shareholders are going to result in the 50% of this corporation being financed by debt. Okay. Now, in perfect capital markets, the fair value is independent of capital structure. That means that the firm value won't change. So $2,000 is going to stand as the firm value. Now, with 50% debt financing, what's going to happen is that shareholders are going to require higher returns on their investments. So, in essence, um, now they have $1,000 of investment. What they expect to receive, the expected return, is 300 minus 100 because 100 goes to debt, right? So the expected return from an investor's investment, an equity holder's investment, is 1,200 divided by 1,000, which is 20%. And we know that in equilibrium, the expected return and required return must be equal. So that's one way of motivating this, right? The required return for shareholders is going to rise to 20%. Okay. So basically, it's saying that as firm returns vary, the returns to shareholders are going to vary more because of the debt financing, right? Because of this $100 that they are giving up to debt holders. Okay, so as a result, this residual payment could go down to zero, which means that the shareholders are exposed to some sort of risk, and that risk is going to present itself in a higher required rate of return by shareholders. Okay, so again, like the case of operating leverage, we can plot the return to shareholders versus the firm's return under the two scenarios. Okay, so if the firm is fully financed by equity, this case here, right? We have this one-to-one relationship, right? Firm's returns goes up by 1%, shareholders' return goes up by 1%. That's clear, right? But when there is debt, we have a different story, right? To see the story here, think about a situation where firm return is zero. So that's hypothetical. That's not going to happen. We know that there's a minimum of 100%. So hypothetically, suppose that the firm's return goes down to zero. So if we're at this point, right, and then the firm is leverage 50%, it means that still the firm must pay $100 of debt, right? That's a negative 5%, negative 10% return for shareholders. Basically, money must be taken away from shareholders in order to meet the obligations, right? So recall that shareholders have $1,000, right, of share value, stock value. They have to pay $100, right, to the debt holder. So 100 out of 1,000 would be negative 10%. Down here is the return to shareholders, right? But if the return goes way um, up here, what's going to happen is that the $100 of payments is going to stand as is. So that means that shareholders are going to receive a lot more than what they would receive if the company was fully financed by um, um, equity, right? Because they only invest $1,000, but they will return a lot more dollar amount compared to a situation where the same amount compared to the situation where they would invest $2,000 in this whole thing. So this is basically showing us how the risk associated with financial leverage works. So again, changes in firm's return, which is some sort of a proxy of firm's profits, is going to determine how much shareholders are going to receive. The greater the debt, the steeper is going to be this line as a result of variations in shareholder returns as a result of changes in firm's return is going to be higher, and that's what we call financial leverage risk. Okay, so let's see another example here. This is like for a particular project. We have a 1-year $50,000 investment project that is going to deliver 20% return. So that's what we expect. If you can borrow 30,000 of the money to invest at 10% rate, so 10% would be the cost of debt here. putting up only $20,000 of your own money, what's the percentage would you expect to earn on your $20,000? So basically here I'm asking for the required rate of return on the $20,000. All right, so we know what the project is going to deliver. We know what the cost of capital is, but we're looking for how much money we're going to end up with for the $20,000. Okay, so the first thing to notice is that, okay, the return on the project is 20%. So this is the monetary amount from the project itself. And then this is the amount that you would have to pay to debt holders, right? Which means that you're left with $7,000 of net revenue had you financed $30,000 or 60% of this project. Now, $7,000 is what you get as a reward for investing how much? Yes, $20,000, which means that you require a return or you expect a rate of return on the equity here is going to be 35%. Again, we're assuming that market is in equilibrium, so required return, expected rate of return are the same. Well, alternatively, we could actually try a weighted average of the two costs, cost of equity and cost of capital to calculate the cost of equity and cost of debt to calculate the cost of capital. Here we're given the cost of capital, right? I have a weighted average formula here, 60% a debt, which has a cost of 10%, and 40% equity, which has an unknown cost of equity. So simply by solving this again, I'm going to end up with a 35% as the required return on equity. Okay. So you guys have heard of WACC, weighted average cost of capital. It's a technical term. It's referred to the average rate of return required by suppliers of capital who invest in the firm. So we'll get to see more of this later, even though we never get to the actual details. It's more of an accounting term, so I'm sure you will see it in your accounting courses. The suppliers are going to demand some sort of rate that is going to compensate for the proportion of risk they bear in the project. And once you average those based on the weight of investment in different projects of a firm, you basically calculate the weighted average cost of capital. All right. So let's look at the components of a particular financing package again. So consider a project that is going to be financed with 40% debt and 60% equity. So this is the opposite of what we just did. The project initial investment is $8,000 and the net present value of $2,000. Okay, so this should tell you that the value of the project is $10,000, right? Because you're taking $2,000 home basically, right? The market value of the assets in the project is $8,000. So the value of the project itself in total must be $10,000. So that's the whole value of the project, which means that if you have a 40% debt structure, you're basically looking at a $4,000 of debt, right? 40% of the 10,000. Okay. Now, the initial investment for the project is $8,000. That's the amount that you need to invest. Now, if you want $4,000 of debt, it means that you have to sell $4,000 of stock. So the equity is going to be $4,000 as well. Now, because equity is going to get the net present value, right? It always goes to equity. It means that the value of the equity is going to include the net present value and is going to be $6,000. Okay? So as a result, we have a project that is being financed 40% debt and 60% equity. So the example here was just to point out that net present value goes to whom? To equity holders. So whenever you talk about the financial structure, whatever the value of the firm is must be considered. That's just another way of saying that, okay, accounting equivalence holds, and we're basically looking at that balance sheet sort of point of view. So how do we calculate the weighted average cost of capital as a result? It's going to be simply a weighted average of two things, the cost of equity and the cost of debt. Nonetheless, we're going to have this 1 minus t in the cost of debt component that basically reflects the tax credits for debt financing. So if you finance your project using debt, you're going to be tax exempt, right? Because someone else is going to pay taxes on that. And as a result, the effective rate that you're going to pay is going to be lower than the pay you pay to your debt holders. For example, if tax rate is 20% and debt rate is 40%, you effectively is going to pay 80% of that 40%, which is 32%. So 32% is going to be your cost of debt. It won't be 40% because you get some tax credit so that government avoids double taxation. So we're going to use this formula to calculate weighted average cost of capital no matter what. So let's look at an example here. I have Nico Corporation. Um, they have 9 million common shares outstanding that each is priced at $30. Then there's a dividend next year on these shares that is going to be $1.33. And there's going to be a growth rate of 5%. So look, we're back to the constant growth model. So that's cool. We're going to apply more insights from the past here. Now, Nico has 60,000 bonds outstanding. The coupon rate of each bond is 11%, and the current price, the market price of bonds, is $1,050, and the yield is 10%. So I want to stop here and tell you, whenever you see yield, it's telling you what the cost of debt is. So this is exactly RE. So keep that in mind. Whenever you see yield, you do not have to calculate the cost of capital. It means that it's given to you. If I did not given to you the 10%, you would have to take this, and assume a face value of $1,000 and calculate the cost of capital. All right, but now you don't have to. Okay, and finally, let's move on. We have the marginal corporate tax rate of 34%. We want to calculate the weighted average cost of capital. So we'll start out with the market value of the company. So to get the market value of the company, we're going to calculate the market value of equity first, which is 117 million. Once you multiply the 9 million by 13, and the market value of debt is going to be 63 million, so 60 times the market price of bonds. The total market value of this company as a result is the sum of those two, 180 million, okay? Which means that leverage is going to be the ratio of 63 over 180. 35% is our leverage, okay? Now, what we need next, we need a required rate of return on equity and a required rate of return on debt. So in order to calculate the required rate of return on equity, we're going to go with the constant growth model. If we know a dividend, we know a price, and we know the growth rate, then those are the ingredients we need to calculate the required rate of return on our equity, which is 15.25. For the cost of debt, or the required rate of return on debt, we're going to just go with yield, just as I said, 10%. And we have this tax rate of 34%. So we have all the numbers that we need in order to actually calculate WACC using this formula. Just plug numbers in, and then 12.22% is the cost of capital. Notice that it's always between the cost of debt, cost of capital. It must be because it's a weighted average of the two. All right, I'm going to pause here and move on to the next video for more insights about WACC.